In this video, we are going to talk about payment flexibility when it comes to whole life insurance. Have you ever had a situation where you get a bill in the mail? Let's pretend that you're going to be billed for $3,000, but you open up the envelope and you see $30,000. Now you were expecting to pay $3,000 and you get this bill for 10 times the amount. What's going through your head? If you're anything like me, maybe your face goes completely white, whiter than my face already is. I know I'm very pale. And you just think, wait a minute, this is not what I was told. How on earth am I going to pay this? That person ripped me off. The guy that sold me this, he told me all these things. In my own mind, I'm thinking all of these crazy things, this big story. Oh, what am I going to do? How do I get out of this situation? And then I hear all of a sudden, oh, sorry, that bill was a mistake. You can actually pay the $3,000 just like I had stated. You can still add up to $30,000. You can pay more if you'd like, but you're only committed to the $3,000 I'd originally told you. How do I feel now? Oh, I feel relieved. I also feel kind of like a fool because I thought this big story up in my mind for no reason at all. Why I mention that is this is the kind of stuff that we often go through just as human beings. We think these things in our head. Now, when it comes to a high cash value life insurance policy, what so many people are attracted to are the cash value benefits, being a safe, liquid, tax-free area to position money, cash rich from day one, all the good stuff that we always talk about. But what often frightens individuals, and it frightens me as well as I refine my decision-making process when looking at the right companies to choose for my policies personally, is flexibility. For example, if my cash flow fluctuates, I might want the ability to pay an X amount of dollars, but I do not want to get this big bill every year because cash flow fluctuates. If I wanted to pay in $100,000, but I can't do it this year because things are tight for whatever reason, I do not want to be billed. So let's demonstrate this. Let's pretend that you want the ability to pay in $50,000 per year. That's how much you want the ability to pay into a policy. However, you don't want to get a bill every year for 50 grand because you don't know if you can add that much to a policy every single year. The good news is you can set up a policy where you are not billed for $50,000 every year, but you can add into it, primarily growing your cash value at discretion. So this does have to do with the limitations on a policy. We're going to pull up a familiar picture here, policy design. So with limits, we have what? We have the insurance company limits, which has to do with our money going toward premium payments and PUAs. Premium dollars, what happens with premium dollars? Any money we pay into the premium component in respect to your cash value, nothing shows up in cash value right off the bat. So typically, what interests many people is lowering that premium as much as possible so they can get more money toward cash value through that PUA rider. So the question I sometimes get is, can I put nothing in the premium because I don't care about the death benefit, Steve? Remember my dad asked me that when I was relatively green in the industry a long time ago. I'm like, no, you can't go quite that aggressive. What we want to be aware of is the limitations that insurance companies offer, and that's where we come up with this 10/90 split, particularly with the major mutual companies. It's not a solid split with each of the four major mutuals, but you'll see generally they allow right around that 10/90 split. And some smaller companies let you go lower. But my point is, a 10/90 split, if I want the ability to pay in 50 grand per year, that would mean what? I could set my base premium at $5,000, of which nothing shows up in cash value in the first year, and sometimes the first and second year. This depends on the company and product. And then beginning year 3, that does come back to cash value, but 5 grand. The other limit I have to deal with is the IRS limit, which is the modified endowment contract, or MEC limit. So I don't want a MEC to occur because if it does, those core benefits of a life insurance policy are what? Safe, liquid, and tax-free. If I trigger a MEC, the tax-free piece is out the window in respect to your cash value. With MECs, the death benefit is still paid out income tax-free. But where I'm going with this is that MEC limit has a direct relationship to the death benefit and the individual's age and gender. But as we set these policies up, really what we want to do is go as low as possible on the premium, maximize the company's limit. So if I want the ability to pay in $50K, I'm going to set the policy up with a $5,000 base premium. I'll add a term rider, as that is a cheap, if you don't like the word cheap, a cost-effective method to raise the death benefit, which does what? Gets my MEC limit up to where I need it at $50,000 or a little bit more. So my annual commitment is this, $5,500 in this example. And depending on the company, sometimes it's a clean $5,000, sometimes a little bit more. It depends on my age, health, and company selection. But this is a general example here. Very close to 10% of my desired total payment, $50,000. So now I can commit to this, and then at my discretion, I can throw another $45,000 into PUAs. Which, what happens with PUAs? They show up in cash value. That's money I can access, begins to compound based on the guarantees, dividends, gets better and better over time. It will buy you some life insurance. The term PUA represents paid up additions, meaning when I make a payment, it purchases me paid up additional life insurance. Why it is paid up is that payments that go toward this rider are optional. I do not have to add them to the policy, although I can if I choose to do so. Let's look at a demonstration here. So here we've got an illustration with a company, and as I always like to do, where's the money going? Here's your base premium, $5,000. So this is a policy where the individual has the ability to go up to $50,000, but he's not committing to it. He doesn't want to get billed for 50 grand each year. So this insurance company will allow him to 10x his base premium, and then his MEC limit is almost at a clean $50,000. So we've got the insurance company limit set properly, and then also the IRS limit set properly. So we have the minimum amount of life insurance needed, which is right here. That gives him that MEC limit of, guess what, 50K. And then based on the insurance company's limitations, we went as low as the company will allow, therefore reducing the expenses reducing the expenses as much as we possibly can. If I could talk today. Now, if we look at the funding here, excuse me, we've got the annual outlay. The first year, he does not pay in $50,000. He has the ability to. That's how much he wanted to get in, but he didn't get it in. $25,000 went in. Same thing with year 2. But then year 3, a total of 50K went in because he can bounce payments up and down over time. Here's your total cash value. Year 1, he paid in 25, had very close to 20. So what did not show up in cash value was the base premium in the first year, also the cost of the term rider, and then you've got a PUA fee as well. But we see still we're overfunding it. Year 3, I pay in 50, I get almost all of that back. And as the years pass, what's really nice about this is we see payments adjusting up and down. So year 3 was 50, then 15, then 10, then 50, 25 again, and I kept bouncing them up and down, really just to demonstrate contribution flexibility for this individual, because so many people, again, are attracted to this guy right here, the cash value. For these reasons, safe, the net IRR will produce somewhere between 3 to 5%. Liquid, I can access that money anytime I want. And then the third, tax-free. Tax-free if we don't trigger a MEC and if we don't cash the policy out with a gain. There's other things that can trigger a taxable event, which we've got other content on. But we adjust payments over time. Great, very flexible. If we look at another example with a different company, there we go. What do we see in the first year? $50,000, Max funded it. He had a $5,000 base premium. You can tell by this guy over here. Then 20, then 6,000, close to the minimum, then 10, then 30, then 30, then 20, and eventually he stops after 10 years in this particular example. So my point here is whenever we start a policy, we do not need to commit to any type of schedule. You can, and you can also adjust that commitment if life happens and such, or you can set up a policy where you commit only to the minimum. A lot of people we work with like to do this, where they say, hey, I want the ability to pay in, say, $50,000 per year. So let me just commit to the minimum. That could be $5,500, maybe it's $6,000 per year. And then at their discretion, they'll add more funds up to a total of $50,000 per year, but they're only billed for this. That way it never feels like a burden or anything like that. It's kind of neat how you can structure a life insurance policy like that. Two of mine actually are like that, where I've got a lot of flexibility where I can commit to a minimal amount and pour more in at discretion, just because I like the flexibility when it comes to PUA payments. So I hope that was helpful. I know I didn't go into any company specifics there. We've got other content on that. If you enjoyed it, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.